Let's get in Devang Shah now, co-head Fixed Income Access Mutual Fund. He's now with us. Sir, could you just talk to us about your views on the recent policy announcement made by RBI?
Our reading onto monetary policy is that still RBI continues with the withdrawal of accommodation guidance, which means that RBI is open towards moving on either side. If they see any kind of shocks on inflation, they might hike. But our view is that if I look across at the macro, which is both growth and inflation, our thought is that inflation is now going to show a downward trend. Our average inflation is very much similar to what RBI expectations are. If I look at to our growth perspective, we believe that again, on the growth side, RBI is being slightly more optimistic. Our growth projections for next year comes out to be sub 6% and inflation projection very much similar to RBI around 5.25 to 5.5%.
Which categories should be considered in debt investments?
I assess the macro where growth is slowing, inflation is showing a downward trend. We are almost at the peak of the interest rate cycle. A large part of interest rate hikes are behind us. Our belief is that incrementally looking at the global data, Fed might also choose to stop and probably stop hiking rates and probably look at a pause. Looking at global macro, looking at India macro, incremental thought processes that rates will remain stable or move in a downward trajectory in the near term. What we are advising clients then is that for parking solutions, like investors looking at shorter term and very, very short term investment horizons and looking at just parking solutions, I think the shorter term category, which is ultra short term money market category funds, makes a lot of sense for investors at this point of time. Similarly, if investor wants to ride the interest rate cycle, we don't expect RBI to do massive rate cuts in this calendar year. We believe that the curve can remain flat. A curve can steepen a bit. The curve is already very, very flat. The curve can steepen a bit. So our thought is that probably a large part of investments, if someone wants to ride the interest rate cycle today also, depending on the macro, they should choose active short to medium term funds.
Devang, talk a bit more about that. You talked about how there is, likelihood of pause, and at least that's what you're penciling in. But what about the expectation of rate cuts in 2023? What are you penciling in there?
I believe that from here on, yes, interest rate cycle should be on a downward trend. We should see cuts. But because I think inflation in India has remained sticky, it will be not very easy or for RBI to do massive rate cuts. So I think if I look across at the best case scenario for CPI in this year, we don't anticipate CPI to fall below 5. With 125 basis of operative rate, we don't see too much room for RBI to cut. So I think at max, we can see 25 to 50 basis of rate cut. That also at the fag end of the interest rate cycle, at the fag end of the calendar year or financial year.
Too much room available for on the rate cut side, at least as far as RBI is concerned. But there have been a lot of changes when it comes to the finance bill of this year with respect to debt mutual fund as well, whether it was LTCG change, etc. as well. Your view on the same?
What changes have happened? So previously, I think debt mutual funds used to get the long-term capital gain benefit along with indexation, and which used to significantly be a tax efficient solution for investors. With the change in guidelines, I think any investment done after 31st March 2023, incrementally the taxation benefit will be the marginal rate. So the tax benefit goes. What we believe so is, if I look across at the mutual fund industry, 2/3 of the AUM in debt funds used to be in less than 1 year category, where investors used to churn. They never used to hold for more than 3 years. So the benefit used to come to investors if investor hold debt mutual fund units for more than 3 years. A larger part of the AUM, which is 2/3, as I explained, used to sit in less than 1 year schemes where investor used to churn their money. So we don't actually see any kind of impact on that, which is 10 trillion. Another 5 trillion of AUM, which was in short to medium term categories, might see some bit of muted flows going ahead. But our view is at this juncture where we are on the interest rate cycle, where the entry levels are absolutely too good, Today also, as I explained to you, everything from 1 year to 10 year on the corporate bond side is available at 7.5 and above. If you look across at the 10-year GSEC also is available at 7.25. So absolute entry levels are too good. If investors, we believe so, we are at the peak of the interest rate cycle. Incrementally from here on, interest rates will go down. Once we start seeing rate cuts, investors would want to ride the interest rate cycle. And I think mutual funds will offer the best solution as well as the best vehicle to ride the interest rate cycle. So once the interest rate cuts start, we believe we'll again start seeing a lot of flows into mutual fund. Currently also 2/3 of the categories, we don't see any impact. The balance 1/3, we can see some muted flows. Incrementally from here on, what are we advising then to clients from mutual fund schemes perspective? I think last 2 years, we have seen a lot of flavor for investors growing in target maturity funds. We believe incrementally the dynamic stroke active gilt funds will make a lot of sense for investors who want to ride the interest rate cycle. So that's the advice to clients.
Okay, and just to wrap it up, Devang, investors can take a long-term view on fixed income schemes like TMFs or long durations as well, right? Or do you suggest that right now short-term is the best strategy to go with?
My understanding is, as I explained to you, I think we believe that for most part of this year, looking at the macro, I think we don't anticipate inflation to fall massively below 5%, and hence we don't anticipate huge rate cuts. With that thought process, we don't want to advise clients immediately go and buy long bonds. It is also the onset of the borrowing program. You just start seeing government borrowing program to start at the beginning of the new financial year. So there's a huge, massive borrowing program. We believe the curve can steepen. Immediately, there are no rate cuts and hence limited capital gains from fixed income funds. So what we're advising clients currently is to stay in the short to medium term category. Once we start looking at Fed pivoting and Fed's cutting rates, I think probably by that point of time, which is second half of this year, the macro environment will be more conducive to buy long bond funds. Currently, we're advising short to medium term category.
Thanks, Devang, for joining us. So for now, the advice is to buy short-term funds, but at least towards the end of the year, there could be a case to be made for long-term as well.